Hi, everyone. It's Bill and Jonathan. So, the burning question is if you're investing in a real estate fund, how liquid are real estate investing funds? That and more right after this. Hello again. It's Bill and Jonathan. Wendy is on vacation. This is the passive accredited investor show, not the passive aggressive investor show.
Just our emails.
We are Carolina Capital Management. We are lenders in the Southeast for real estate investors. If you are interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you are a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe.
Hit the bell.
Hit the bell.
I don't even know what that means, but I really want to do it.
And lastly, don't forget about Wednesday with Wendy. Wendy donates Wednesdays to anyone that wants to talk about real estate investing. There's a link to get on her calendar.
I think it's 30 minutes
schedule.
Free.
Yeah. Yep. And she's usually booked out a couple of months in advance. So go ahead and get in line now. How's your day going?
It's pretty good. Pretty good. We closed out June.
Yep.
And
started the third quarter today.
Yeah, looking good, looking promising.
So what do they call the next 2 weeks?
I call it vacation.
Typically in the stock market, this is called earnings season. When all the major stock companies report their earnings. Speaking of breaking news, by the way, we weren't speaking of breaking news. I just wanted to throw a curveball at Sharub, putting up the graphic. She did well, though. I didn't mess with her too much, huh?
That's right.
Excuse me. So if you're wondering if the housing market is heating up.
If you're wondering that, you live under a rock.
So the May numbers came in because, they're a few months behind. 14.6% is what the
appreciation.
Price appreciation has gone up.
And it's a national number, right?
Yeah.
Yeah.
Since last May, 14.6%.
That seems pretty decent.
Yeah.
Yeah.
It's not sustainable, obviously, but if you're a seller, this is great news. If you're a buyer, it's not great news. If you're a real estate investor, it makes it tougher.
Yeah. I mean, I see people. It's coupled with an inventory issue as well.
Sure.
So I had a conversation with some guys the other day, and they were saying, I can get X amount of money for my house. I'm like, great. Where are you going to go? Well, I don't know. It's like there's an inventory issue. Like that's the I harp on this all the time. That's the problem. Is we have these giant REITs and hedge funds borrowing at almost next to nothing, causing prices to just keep rising because they have no cost of capital. They can pay 40, 50, 100,000 over asking price. And people, you think, oh, this is a great deal. I'm going to cash out my equity on my home. And then it's like, well, the buy-in cost now, what you cashed out isn't even enough to cover your 20% down or whatever it may be on your next home.
Well, I mean, if you're, excuse me, if you're in that position where you're downsizing anyway, you've turned into an empty nester, now's not a bad time to sell. You're going to be paying a little bit more for that smaller home, but you're still going to have plenty of money left over.
Yeah.
Assuming you didn't have it mortgaged to the hilt in the first place.
Yeah.
But
But
now's
from
not a bad time to rent. While rents have been going up, they haven't been going up nearly as high as the
if
appreciation.
you can find a place to rent.
Yeah.
That's
Depends
another
on the
issue.
market that you're in.
Well, I mean, if you're coming to the Southeast, like when we're talking about this, we're talking locally right now for homes and rental properties and just apartments in general. It's tough to find them.
Yeah,
it's really tough. What was the inventory? What's the days on market, or not the days on market, but the days of inventory for
we had
Charlotte?
18
18
last
days.
month.
I thought it was 17. I think it actually went slightly down. So finding a place is and it's not your primary residence, sell it. If you want some cash and you have a place to put it that has low tax liability, sell it.
Yeah, if it's a rental property and you always want to take a look at your portfolio, see which ones have the most equity. It might not be a bad time to get rid of the ones that are the most headaches.
Yeah.
Because we always have stinkers in our portfolio. And,
yeah, I mean, if you're doing it right, I mean, you're always going to have some.
Yeah. That said, I was reading in the Mecklenburg Times. If you are in our area and you're a real estate investor, you need to buy the Mecklenburg Times. It's a very small investment, but they have a lot of real estate stuff in there that's very important. So another Case Schuler report and article had to do with home flipping. It's the lowest profit margin in years and years for flippers, and it's obvious because flippers are having to pay more for the homes.
Yeah,
because they can't.
And for the materials,
and it costs more to. The supplies are a lot higher.
Yeah.
That said, the average margin was still over 40% return. So
that's okay.
That's still not bad. It's not doom and gloom. It's just you're going to have to pick and choose. You don't know when this is going to end. And in my opinion, it's not going to. You're not going to see prices come down. The only thing you're ever going to see is the rate of appreciation slow. Homes are still going to go up in value. We're going to have a total meltdown of the housing industry, and I don't see that ever happening again. They fixed that problem, right? I mean the mortgages that they're underwriting right now are the best that I've ever seen. The most stringent.
Well, problems usually carry with them several variables, and even though one has been fixed, there are other variables that could be met to create the same problem.
But the biggest variable is supply and demand, and it's going to take us a boatload of time to catch up with the supply and demand.
Yeah.
Right.
Well, I mean, as long as people don't get priced out of homes, I mean, that's the issue. I think that a lot of people are facing is your first time home buyer? I mean, at this point, even like your second or third, are they getting priced out of the home? The ability to own a home.
Yeah, and every time I hear the experts speak on television, they always talk about the 20% down you need. I don't know anybody that ever put 20% down.
No, there's so many
not
ways.
On their first home.
Well, not on their first home, and I mean, honestly, like not really on your second. I mean, you can still get a conventional loan with 5% or more down.
Yeah, no, and I get that. Perhaps if you're buying an investment property and you've sold your property and you're using proceeds to buy the new one, you're putting a lot more down. But most people aren't. I mean, you would like to be at 80% so you're not paying private mortgage insurance.
Yeah.
But that's not an issue. And affordability is still there.
In certain markets, sure.
It is. And I'm talking about monthly payment now. It's still low because rates are low. Prices have to go up considerably in order for you not to be able to qualify for the mortgage payments typically. The down payment would be an issue.
Yeah,
I get that on the affordability side.
Yeah,
but rates are going to have to go up tremendously in order to price people out. Now, what's not helping is the inflation, and let's see if it's temporary or not. Because,
Transitory, right?
Yeah,
Transitory.
Yeah, I love Fed speak.
I know transitory. Well, it's transitory, but right now it's lost in traffic right now.
I heard a great joke this morning. If you're not a financial geek, you're probably not that funny. But Alan Greenspan, they were so happy nowadays because the Fed is actually speaking in plain language instead of in code, like Alan Greenspan used to do. He would talk for an hour and you don't know what he said.
Yeah.
And one guy said that he had to propose to his wife 3 times because first 2 times she didn't know what he was saying. So I think it's time to move on to our ugly question of the day. Okay, now that we're centered up once again, we need an X, and by the way, because we keep shifting around. I don't know why. Eventually, we're going to be looking over here at the wall.
Look at each other.
So our question is, how liquid are real estate investment funds? And that really is a good question.
It depends on how underwater they are.
First of all, they're not.
I mean, I got to throw it in there.
When you invest in a fund of any type, it really is not a temporary investment. You really need to be like if you're investing in the stock market,
Mm-hmm.
you're not a trader.
Mm-hmm.
Traders trade every day.
Yeah.
Sometimes every hour.
Yeah.
But if you're an investor in the stock market, you have a 3, 5, 7-year plan.
Or sometimes some people have 20, 30.
Right.
You know, yeah.
The same thing with investing in real estate funds. You need to have a 2, 3, 5, 10-year plan.
Mm-hmm.
It's no different there.
We have to figure out, are you trying to, create principal preservation and, get a solid, return, or are you in growth mode? I mean, same thing you're thinking about in the stock market. It's the same thing. Where are you in life? Have you built up a giant portfolio, or not portfolio, but nest egg, and you want to put it somewhere and protect it? Don't want to lose it. Or are you trying to build up that nest egg?
Sure.
Yeah.
And it depends on the fund structure.
Mm-hmm.
And what it is that the fund is investing in. Correct?
Yeah. I mean, I would say the most illiquid funds would be those that are like syndications on specific properties, because typically they're negative cash flowing for the first year or two, if it's a heavy value add or new construction. And then after that, it's a 3 to 5 year lease up stabilization. So
right.
Those are very illiquid. You don't see liquidity until 5 to 7 years down the road.
So basically, if it's a new development of a project, it could be commercial development of single family housing.
Mm-hmm.
I mean, how long does it take from the time they get the capital, break ground, put in all the infrastructure, and then start building homes? How long does that usually take for a subdivision?
It depends on how big the subdivision is. I know it takes, the one we did was for 44 units. It took right at 10 months.
Okay. You get into a commercial development with mixed use, maybe some residential and restaurant, retail. Sometimes they even have a little bit of hospitality in there. And that takes years to finish out,
mm-hmm.
right? And there is not going to be any liquidity in those at all until the project finishes out and stabilizes. And you might be in that thing for 5 to 7 years before you start seeing any actual money, or even be able to get out of the thing if something happens. And you need to invest with money that you don't need to touch for quite some time. Now, we all understand that life sometimes gets in the way, and there might be an emergency need to get some capital out. If you're in one of those types of commercial syndications, there is little to no chance that you're going to get your money back.
The only way you could get your money back is if you could get someone else to take your spot and buy your position out. That would be the only way.
And then obviously you're going to lose any upside to that investment.
Yeah. And
you probably would have to sell that position at a discount anyway, just to get most of your money back.
Mm-hmm. I mean, more than likely.
In an open-ended fund, it's a lot easier to do that. Most funds have
So when you say open-ended,
Well, a syndication or a value add proposition is closed end, meaning it's going to have a beginning date
Mhm.
and an ending date.
and those typically
once it's
run
filled-
3 to 10 years is
Right.
that's pretty typical. Yeah.
And once the fund is filled, nobody can get in or out after that until the project is complete and it
Mhm.
pays out.
Yeah.
With an open-ended fund, it just continues. You have investors going in and cashing out through the life cycle.
Yeah.
And most of those types of funds are note funds and mortgage funds like ours, funds that lend money. You can have some that are opportunity funds where they're buying properties. Maybe they're wholesaling properties in them. Maybe they're doing some fix and flip and a little lending. They can have a, whatever the deal calls for. That's why they call it an opportunity fund. But there's stuff moving in and out all the time, and it's easy to do an open-ended fund where people can get in and get out. Now it gets a little complicated with owning property in those types of funds because, how do you evaluate the value of the portfolio when you have loans and real estate involved? And that's one of the reasons we try to make it simple. That's why we just stick with either notes or lending.
Well, and so we've talked about that. What, in our opinion, the most liquid type of fund would be a fund that is open-ended and only participates or contains debt instruments.
Right.
And debt instruments on primarily single family homes in the United States.
Yeah.
Because how many emails do you get a day? How many emails do I get a day from large hedge funds or aggregators of many sorts? Hey, you got any loans to sell? We're buying loans. We're buying loans.
And all of them have a short-term look at this too, because they want to do the short-term stuff.
Well, the short-term's sexy right now. I mean, we don't know what's going to happen in the future. Short-term helps mitigate that risk of not knowing, and you also are getting a higher level of return than typically on the 30-year mortgages. So it is a very sought after item.
It's very difficult to turn the cruise ship quickly.
Well, and like one of our members in our fund was texting me last night and asked me the question: would you rather do one loan and make 10% with X amount of money, or have 5 different loans and make 9.25%? And I was like, that's a great question. And it's to me that echoes on a syndication versus an open-ended debt fund. A syndication would be the one loan at 10%. You're going to if it goes well, you're going to make more money on that type of offering.
Yep.
In that fund, you're going to make a lot more money if it goes well. On the other side, on the debt instrument fund, you're going to make less money. But the occurrences of negative activity on these loans is much less. And also you're diversified across many loans. So if one does go bad, you haven't lost everything.
Yeah. I mean, that goes back to, if you're a banker of any sort, you always want to have 5 $100,000 loans versus one $500,000 loan.
Yep.
Because while you make the same amount of money on both of them, essentially,
but not on the same street.
You don't want them on the same block, because if one of them goes bad, that lowers the value of the other 4 that you have.
Uh-huh.
That's assuming you have to sell it at a discount.
Yeah.
In this market, you make profit when you sell it.
Yeah.
But for the most part, you're diversifying your risk, and you always want to try to diversify your risk. Now, I'm sorry.
No, go ahead.
I was going to say, getting back to the main question,
Mm-hmm.
How liquid is your money? Well, the most liquid is going to be note funds and lending funds, especially if the lending fund is doing short-term loans.
Yep.
chances are a loan's going to be paying off every so often.
I mean, yeah, I mean, they're 6 to 12 months. So there's liquidity there as they pay off.
Right.
But then, on the secondary market, like we were just talking before, the opportunity to sell those loans is another way to have liquidity.
Well, even the opportunity to sell them if they go bad is better.
Yeah.
Because single family homes, for the most part, are the easiest to sell because most people want those. If you stay in the affordable housing side of things, they're even more saleable because you've opened up the investors that would want to purchase them as well.
I mean, just think about those. There's 2 loans that we were foreclosing on, 2 properties. We didn't even get to foreclosure. Someone just bought the notes from us.
Right.
They just bought it for what, we made money on it and they just took it over.
Yeah.
Like that's pretty liquid.
Well, and that's the case in an up market. It's not always going to happen if the market is slowing. But you're always better off on that side in a lending fund or a note fund in order to do that. You've got a little bit more upside if you're doing the value add, but you're going to be less liquid because you can't pull liquidity out. And if the thing does go bad, you have even fewer people that are going to be interested in buying this. So your buying public is even smaller. Yeah. So those closed-end funds that are syndicated type funds, you're not going to make as much. I mean, you have a much higher upside, but it's going to be less liquid. And then you get into the development stuff.
Yeah. I mean,
it gets really tough.
That same investor in our fund. I mean, same thing. They're just like, we're talking about a loan sale, and he was saying like, oh, I'm not sure that's enough. I'm looking for higher yield. I'm like, there's always higher yield out there. Yeah. It's always coupled with higher risk or higher levels of work, and usually both.
Right.
So there's always more yield out there. It's just what are you sacrificing for that yield?
And one of the phrases I'm always using is return on effort. And if you're having to do a lot of effort, is the return that great?
I mean, yeah. I mean, when you look at the number of hours or the sleepless nights that you have to spend, that's not something I'd rather sleep good every night and make a little bit less.
Yeah.
That's just me.
Well, me too.
Yeah.
All right. Well, listen, we're going to wrap this up. We're going on a vacation next week, so we're not going to have a show. Sorry to disappoint you, but we have plenty of archive shows on our website and on this YouTube channel that I encourage you to go back and look over.
I was thinking we could have the ladies in the office here, Melanie and Dion, do the show. That'd be great.
Well, I would love to have them do the show because they are full of knowledge.
They are very full of knowledge.
They're a little camera shy.
Melanie's very camera shy.
Yeah. You guys have a safe and happy 4th of July. Thank you once again for joining us on the Passive Accredited Investor Show. We are Carolina Capital Management. We are lenders in the Southeast. If you are interested in borrowing money and you're a real estate investor, go to our website, carolinahardmoney.com, and click on the Apply Now tab. If you're an accredited investor and you're looking for passive returns, then click on the Accredited Investor tab. Don't forget to like, share, subscribe.
Hit the bell. I know they hit the bell one. Yeah. I'm gonna hit that bell. I'm gonna find that bell.
And don't forget about Wednesday with Wendy. Again, Wendy donates her time on Wednesday to talk real estate investing with anyone who wants to, but she's always booked up in advance. So there's the link there in the chat to get to her Calendly site. We thank you for joining us once again. Have a wonderful 4th of July. You guys take care. See you in 2 weeks. Bye.
See ya.